Hello, I'm Michael, a United States stock market analyst, and I'll start today's United States stock market news on April 2nd. As always, I welcome you to Michael, who is maintaining the stronghold of United States stock investors without change. As I've mentioned before, I have lived in a total of 6 countries and 9 cities for more than a year each. In a way, like Mr. Yumok, I've lived a somewhat nomadic life. So for those who don't know me well, they might assume that I dislike a stable life, but in fact, I'm quite the opposite. I really like stability and routine, doing the same thing at the same time, and eating the same food repeatedly. I find such an unchanging life extremely comfortable. So, I wake up at a very regular time in the morning, and I don't really sleep in on weekends either. I've been waking up at the same time, between 4:30 and 4:45 in the morning, almost all year round. But starting this week, I've been having a bit of a problem. Despite waking up at the same time, there's a system in the United Kingdom which is called summertime in Korea, daylight saving time, where the time goes an hour faster. So, even though I wake up at the same time, in reality, it has the effect of waking up at about 3:30. So this week, I've been feeling tired and drowsy all day as usual. So even as I prepare for today's broadcast, I wonder why things are going so slowly, and I feel a bit sluggish, which is a bit worrying, but I'll try to keep my focus and proceed with the broadcast today. The market situation isn't good either, so it wouldn't be good if I also struggle. Anyway, starting on April 2nd with a somewhat tired and blank feeling, let's start with today's United States stock news. Before we proceed with today's broadcast in earnest, thank you for your notice today as well. We are currently running a free ebook event for our current members and readers. A while ago, I appeared on a channel called Hawaii Selection and had an interview. Many of you watched this interview video and gave me a lot of positive feedback. So I will tell you what I talked about when I appeared on Hawaii Selection. At that time, I talked about the essence of United States stock investment, which is included in this newly published book, Various Investment Strategies and the Philosophy of Investment. But the feedback was so good that I spent about an hour and a half recording what I talked about on this broadcast. So I ended up talking a lot more than I had planned. I've been distributing a free ebook where I've organized what I talked about into text for everyone. The application period is until Thursday, April 3rd. There's not much time left now. And there's a link to apply here. I'll try to put it in the pinned comment, so please click on the application link. I believe that you all can get help in overcoming the long-term depression that you are experiencing this time. I hope many of you apply for this opportunity. I think it would be good if you use it as a stepping stone for future investment decisions. Well then, I will try to summarize the expectations of the United States stock market yesterday. Yesterday, for the first time in a long while, we saw a lot of green, and overall, the market was in the black. It was a bull market, and the tech stocks we're interested in were the top performers. It was a good day, as the stocks that had been the most burdened recently showed a rebound. However, this does not mean that the market sentiment has reversed. For example, if you look at the big score, it's still at a very high level. It went over 20 again a while ago. There's no sign yet that the atmosphere is improving as it hovers around 22, 23. The Fear and Greed Index also shows the same trend. The Distribution Exploration Index has plummeted to 15 now. It was 19 just a day ago. So, the current fear in the market is extremely intensified, and the Fear Exploration Index has dropped this much. What does it mean? Of course, people are on tenterhooks about the expected Trump tax announcement today, and they are still feeling a tremendous sense of insecurity. It can be interpreted in this way. Here are the scores of yesterday's NASDAQ top picks. Most stocks rose. B2 was the best, rising 6.31%, and MicroStrategy rose 6.16%. Bistarga was up 4.09%. Talon Energy up 3.89%. Cred Technology up 3.88%. Tesla up 3.59%. Next Tracker up 2.16%. Innodata up 1.78%, Meta up 1.67%, Nvidia up 1.63%, Taiwan Semiconductor up 1.59%, Alphabet up 1.57%, Amazon up 1.00%, Bitcoin up 0.93% with 85,130 transactions, Broadcom up 0.65%, Palantir up 0.33%, Celestica up 0.32%, and finally Uber was up 0.18%. Well, it was a good market with all 18 types of top picks rising in unison. Well, on the first day of April, the United States stock market showed a rebounding trend. However, despite this, the past 3 months of January, February, and March have shown the worst period for United States tech stocks comparing to the artificial intelligence performance stocks. So let's start by looking back at what happened from January to March. Tax uncertainty, United States fiscal tightening, and recession fears have led to a challenging time, with the Nasdaq 100 recently hit hard. The fear was especially concentrated on artificial intelligence stocks. Thus, many factors have collided with great force. Firstly, there's Trump's tariffs. Secondly, the government continues to cut spending. And thirdly, the threat of economic recession is increasingly intensifying. Lastly, could artificial intelligence be a bubble? As concerns about these issues have increased, the United States stock market has shown a very poor trend for 3 months. You can see this. Tech stocks, particularly the Nasdaq 100, which is considered the benchmark for the tech sector, performed poorly. Last week, 2 warnings were issued that the money inflow into the data center infrastructure could decrease, and after that, it fell by as much as 8.3%. It recorded the worst period in almost 3 years. As a result, the selling pressure intensified again, and the counter-rally disappeared. Investors were once again put at risk. Until recently, the biggest movers in the market were the stocks, where damage is now being inflicted. For example, Nvidia's stock price has fallen by 28% from its peak in January. Broadcom, for instance, is down 33% from its December high, and Microsoft, Amazon, Alphabet, and Meta platforms have all had a pretty bad first quarter, each down more than 20% from their own highs. It seems we can summarize it like this. Michael Mullaney, the global market analyst at Boston Partners, is coming out. Regarding artificial intelligence, it's more of a question here, but I guess it's more of a doubt than a question. In a time when general anxiety about artificial intelligence is increasing uncertainty, and in a time when it is close to perfection and being traded at a premium, it was proposed. So, it means that the timing was not very good? Even if not, the fact that questions about artificial intelligence are emerging now is a bad sign. When viewed in that context, due to the current Trump administration, there was no choice but to send a very unfavorable quarter as the overall uncertainty increased tremendously, and another stock price rose too much at a time when questions about artificial intelligence collided like this, focusing on tech stocks. That's how it's organized. This is becoming a clear place for investors who are broadly anxious to realize profits. Even if not, the tech stocks have risen tremendously over the past 2 years, haven't they? So it's providing a sufficient reason to realize profits, as it were. Tech giants have attracted United States stocks over the past 2.5 years, with expectations for future profits due to artificial intelligence. The Nasdaq 100 index, which hit a low in February, has more than doubled from its low in December 2022. It doubled in just 2 years, which was tremendous growth. What is the average valuation of this index? It fell from 27 times last month to 24 times, but it still maintains a high level compared to the average of 20 times over the past 20 years. Yes, as you can see here, the valuation has dropped significantly, yet, despite the fall, the average is still at this point. So we're currently recovering to the average, but we can see that it's still slightly elevated. Personally, I believe that it's more likely to rise than the valuation from 2015 to 2020. Why? For us, the artificial intelligence era has only just begun. And last week, 2 pieces of bad news collided, causing the artificial intelligence sector to fall further. Alibaba's co-founder is leading the demand for artificial intelligence services in order to create a new paradigm, he said. Therefore, there was no choice but to worsen recent artificial intelligence concerns. The following day, an article analyzing Microsoft's $800 million allocation for data center construction this year was published. Microsoft has decided to withdraw from new projects in the United States and Europe due to public supply and demand. When these two negatives collide, the trend of artificial intelligence leaders becoming increasingly conservative is seen. And these warnings are about the shortage of computing resources in China, which has led to the training of advanced artificial intelligence models being discussed. Since DeepSeek has only recently emerged, it's inevitable that people are excited about it, as you can see. Such models from China have raised questions about the assumptions about the resources needed to maintain the dominance of American tech giants. What does this story mean? Microsoft, Alphabet, Amazon, Meta. These four companies are expected to exceed $300 billion in capital expenditures in the current fiscal year. You might think there's no need to spend this much money, but there are many investors who think this way. So, if these expenditures decrease even a little, it would be big news. Chips, servers, energy, networks, all kinds of artificial intelligence switches have seen a tremendous increase in stock prices. But in such fields, they are bound to take a big hit. Don't you think we can predict that? I will try to hear the opinions of market experts. Barry Nailbuff, the managing partner of Ironside Macroeconomics, is coming out. If the investment return rate is more clear, the concerns about whether hyperscalers will continue to invest in the way they have done so far will decrease. This means that not many companies are experiencing rapid sales growth by leveraging artificial intelligence yet. Meta's stock price is performing well currently because the company has demonstrated a trend of consistently boosting sales through the use of artificial intelligence. There are other examples like AppLovin, and Palantir was the same. So, among the artificial intelligence implementation stocks, companies that show a trend of their sales or profits rapidly increasing, you see their stock prices going up. Many companies can't do this. The important point now is, the point is that more and more companies need to show a trend of their investment returns gradually increasing. Only then will investors think, artificial intelligence really helps, and American companies will make a lot of profits in the future, and their worries can be reduced. That's how I understand it. Well, due to the recent sell-off, many artificial intelligence-related stocks have started to look attractive from the perspective of the lecturer due to the drop in stock prices. Ben Ray, an analyst from Merrill Lynch Research, is coming out. Nvidia's stock is expected to reach a level 23 times its earnings over the next 12 months, which is very defensive. When we usually evaluate stocks, it's about the probability that this stock can rise, and if it does rise, how much room is left, how much upside potential the stock price has. We analyze the potential fall, its extent, and the probability of it occurring through comparative analysis. So interpreting the opportunity and risk, if there are more opportunities than risks, is considered attractive. So in the case of Nvidia right now, the stock price has fallen so much that the price-earnings ratio is at a level of 23 times. Therefore, it can be understood as the opinion that the safety standard has been secured. Well, despite this, the current monthly distribution of orders is clearly a gloomy atmosphere. Last week, the cloud computing provider Core Web went public, but the company's opening was almost a failure. There was hardly any interest, remember? This company is a company that is receiving support from Nvidia. So we could feel the atmosphere of Nvidia directly in this Core Web's initial public offering. You can see it this way. According to Kel Forrest, the top investor of Boca Capital Partners, the overall situation shows how much investors are anxious about the artificial intelligence bubble burst. The failure of Core Web's initial public offering this time seems to be decisive, and it seems understandable this way. For reference, I will check the options of the medium target again. When we base it on the forward price-earnings ratio currently, the most a bit fallen, if we decide the order by type, first, the next tracker has fallen to 11.28. Compared to the expected rank to be made in the next 1 year, the market capitalization does not exceed 11 times. The second cheapest stock is VST Vista, which is trading at 16.46 times. Following that, Celestica is at 17.13 times, Google is at 17.18 times, and TSMC is down to 18.22 times. In addition, stocks like Uber, Meta, and Nvidia are still maintaining the option of extremely cheap stocks, and that's how you should see it. This time we will try to rank again by changing the standard to price earnings to growth price earnings to growth is. Forward price earnings ratio is divided by the current growth rate, So when you consider the growth rate, you can determine which type is the cheapest and this seems to be an important opportunity. Still, the price-earnings ratio of Tech Valley is not that low. It's 66 times. Because the growth rate is so good, the price earnings to growth has dropped to 0.42, and the second is TSMC, which boasts an incredibly low price earnings to growth of 0.57. The third is Celestica with 0.58, Uber with 0.62, Nvidia with 0.68, and Nextracker with a price earnings to growth of 0.77. If the price earnings to growth is below 1.0, when compared to the growth rate, the current valuation of this stock can be considered extremely cheap. Next, I will share the current return rate of the average portfolio. This is the first broadcast of April since I took a day off yesterday. I have been continuously sharing with you the investment results of the past year at the beginning of each month and the investment results of the past month on an ongoing basis. For the new readers who have recently joined Migion, let me explain once again, Migion is studying a rather unique investment method called the momentum investment strategy. Currently, I am dealing with 18 types, but often up to 25 types. The number of types varies, and these types are selected based on two criteria. The first is the growth story that the company has. We look at how large the market is, whether it's in a market with a large sleeping power, how low the penetration rate is in this market, and whether it's a company with a high market share, and various potentials that the company has. And secondly, we check the fundamentals, and this part is very easy. Whether it's Seeking Alpha or a stock analysis tool like ChoiceStop, we use it. Through various indicators such as growth rate or profit rate, fundamentals are expressed in numbers. Well, we decide on the stocks while considering these two things. For example, we put it in a portfolio of 20 or 30 stocks. And what I consider most important here is the momentum. All these stocks are good, but which stock's price is the strongest among them? So, which stocks continue to rise? I also continue to buy and increase my investment ratio. And if there's a stock that's good, with a good growth story and fundamentals, but the stock price keeps falling, I also continue to sell and reduce my stock investment ratio. Well, in this way, many people are investing in the opposite way to the method many people use. So many people still find it hard to believe how effective this method is. So if I do this, I keep revealing how the return rate is when I invest like this and I'm operating a portfolio, I think you'll see it this way. I use Samsung Securities and I transparently disclose the profit rate situation through screen captures on the web page. I think you can see it this way. Well, based on the end of March, I will show you what results we have achieved during 1 month from the end of February to the end of March. As you can see, the investment profit exceeds a whopping minus 7 million won, and the monthly return rate is minus 7.79%. It's not very good, is it? And if I show you the results for the past year, the last second quarter, third quarter, and fourth quarter were very good. Therefore, 2024 was good without any further downside. For those who have recently become members, and for those who have recently become subscribers, let me explain. In 2024, the mid-June portfolio's return rate surpassed 100%. However, after 1 minute, it has now dropped to 22.31%. In terms of money, it's a loss of over 220 million won. So looking at the whole year, the profit rate has plummeted to 14.86%. The period profit is still recorded at plus 7.7 million won. Anyway, you can see that my portfolio was devastated in February and March. I will compare the typical benchmark return and my portfolio over the past year based on April 1st. The S&P 500 has been plus 68% over the past year, and the Nasdaq has been plus 63%. The Momentum Quantum portfolio of Mijuan is plus 1,486%, so it is still beating the market index. You can see it this way. Comparing the benchmark return rate and Mijuan's portfolio return rate for March 2025, the S&P 500 is 5.76%, the Nasdaq is 8.21%, and minus 7.79%. Therefore, in conclusion, the portfolio was composed mainly of artificial intelligence stocks with very high volatility. The March drop in Mijuan's portfolio was much worse than the S&P 500. However, the fortunate part is, By reducing the stocks that continue to fall and buying more of the rising stocks, the overall decline was slightly less than the Nasdaq Composite. I personally evaluate this part as positive. However, despite this, it recorded a huge decline of 22.31% in the first quarter of 2025, and the current loss exceeds 2.2 billion won. Therefore, I personally think it's certain that we're going through a very difficult time. However, to repeat, the risk in the stock market, that is risk, means volatility. And we are currently constructing a portfolio with high volatility stocks due to our own choice. Compared to other stocks, whether it's a tech stock or a growth stock, the volatility is high. If other stocks zigzag this small, the high volatility growth stocks zigzag tremendously, and there is one reason why we chose stocks with high volatility. The reason is because we want to increase our return rate, even if it's a little better than others, meaning the performance of the stock. However, does choosing a stock that can have a good return rate mean the opposite? During a bear market or correction, anticipate that your portfolio's return rate may fall more than others and manage accordingly. That's my personal opinion. If you can't handle the volatility you've chosen when such a correction occurs, ultimately, volatility becomes a risk and you end up with a reduced investment return rate. Therefore, volatility is a destiny that we cannot avoid when investing in growth stocks and tech stocks. If we understand and accept this as a characteristic of the market, volatility is not a risk but an opportunity, and I want to reiterate that we can create a new paradigm of investment for ourselves. From our investors' perspective who are betting on United States stocks, last March was extremely tough. However, there is one piece of good news. Historically speaking, the outlook for United States stocks in April is extremely bright. What's this about? Let me briefly introduce a part of this article. It's from Julian Emanuel, a technical market strategist at BTIG. He provides us with a chart, and according to this chart, the April market is expected to rise, like this in the market. Well, what's the story? It's very rare for the S&P 500 index to fall more than 3% in a month of March. But this time it fell more than 6%. Well, looking at the past 7 times when the S&P 500 index fell more than 3% in a single month of March. Historically, the month of 5.92%. Well, here it is. After the end of World War II, there were 7 times. So there were many times in March when it fell more than 3%, but the problem is, when I looked at the results in April, there wasn't a single minus. The average return rate is an impressive 5.92%. So if history can repeat itself, because March was not very good, there is a high possibility that the United States stock market, which started yesterday in April, will bring us a very good profit. I think I can send you positive news. The title of the last prepared article for today is a bit abrupt. The era of United States stocks is over, which is a title that often appeared in the 2022 bear market. Recently, as the adjustment of the United States stock market has been somewhat long-term, the view that the heyday of the United States stock market is over is being found here and there. Well, what kind of logic are these people pushing? I will briefly mention my personal opinion in the article, so let's read it together. This article will be read together with my voice, replicated by artificial intelligence. That's all for today's broadcast. Thank you for staying with us until the end. Despite today's scheduled announcement from the Federal Reserve, there's a bit of uncertainty creeping in, which could lead to a downward trend in the United States stock market. We're all together in this fight until the day we retire our United States stock market investments. Have a blessed day. Thank you. By the end of 2024, the rumor of a foreign lord in the United States led to a surge of money in the United States stock market by investors around the world after President Donald Trump's election victory in November. However, 3 months into the new year, the situation has changed dramatically. During the first quarter of 2025, United States stocks struggled as mass trading on artificial intelligence was suspended and the certainty of United States exceptionalism was questioned. Meanwhile, global competitive markets are quickly progressing. As a result, the S&P 500 is lagging behind global stocks. Measured against the performance of the Morgan Stanley Capital International All-Country World Index, excluding the United States, it has fallen nearly 11 percentage points during the first quarter. According to Dow Jones market data, since the end of 1987, this is set to be the strongest performance of international stocks during any first quarter on record. Indeed, United States stocks have significantly outperformed the international competition over the past 20 years. Since the end of March 2005, the S&P 500 index has risen 370%, while the Morgan Stanley Capital International All-Country World Index ex-United States Exchange Traded Fund 65%, according to Dow Jones data. These figures exclude dividends. After such a strong return on the United States, it's now clear that a catch-up trade is underway. Ryan Demas, the chief investment officer of Durham and Assoc Investment, said in an interview with MarketWatch on Monday that we are beginning to return to our average. And if the past is any indication, such a trend could continue for the rest of 2025. There aren't many instances where international stocks have significantly outperformed United States stocks at the beginning of the year. However, when such an event has occurred in the past, there have been many instances where high returns continued for the rest of the year. Dow Jones market data has analyzed periods when international stocks have outperformed the S&P 500 index by more than 5% during the first quarter. This data can be confirmed in the table below. Excluding a few exceptions, stocks from countries outside the United States have generally performed well during the first quarter of this year's Morgan Stanley Capital International All-Country World Index ex-US Exchange Traded Fund period. According to Dow Jones data, the STOXX Europe 600 ticker SXXP, which includes stocks of companies traded in the United Kingdom and Switzerland, has outperformed the United States S&P 500 index in the first quarter, marking its best performance since 2015. Meanwhile, the Japanese Nikkei 225 is struggling, with a decline exceeding 10% in local currency terms. Recent data from FACT-SET Responsible Owner. For foreign investors owning United States stocks, the market fluctuations of 2025 were particularly stressful. This is due to the depreciation of the United States dollar, along with the stock price index like the S&P 500. According to FactSet data, while the S&P 500 index fell more than 55% during the quarter, the value of the United States dollar, compared to major competing currencies, depreciated by about 4%. This is a highly uncommon event. The dollar and United States stocks haven't fallen simultaneously in a quarter since first quarter 2018. As the currency weakens, it becomes a double-edged sword for foreign investors. Over the past decade, the United States dollar has been so strong that many foreign investors who bought United States stocks decided not to hedge their currency exposure. There is a concern that as the wealth of United States stocks grows, international investors may risk investing in Europe or other markets by taking out money. In this case, the loss of United States stocks can worsen, and a vicious cycle can begin. United States stocks were primarily owned by United States investors. However, after the start of the 21st century, foreign investors began to enter the United States market. According to data from the Federal Reserve, the proportion of United States stocks owned by foreigners reached a record high of 18% by the end of 2024, thanks to the influx of global investors attracted by the low interest rate environment. This is an increase from 7% in 2000 and 2% in 1960. According to Goldman Sachs, as of the end of last year, United States stocks accounted for 57% of the total value of the global stock market, surpassing the total amount at the peak of the dot-com bubble in 2000. Since then, the proportion of United States stocks has decreased to 54%. Hardy Singh, the economic strategist at Fundstrat Global Advisors, believes that the performance of international stocks is a result of the shock trade after the dominance of United States stocks. However, she does not confirm that this marks the start of a sustained change. Trump's tariff policy has injected more uncertainty into the market and the prospects of the United States economy, but because there is a possibility that the United States' trade partners will retaliate, the economic impact will occur globally. Therefore, if Trump's tariffs have a harmful effect on the economy, that pain will not be confined to the United States alone. However, as it stands now, American companies are expected to see much stronger profit growth than their global competitors by 2025. This supports the expectation of a trend strategy that United States stocks will rebound before the end of the year. Singh said that the continued good performance of the United States actually benefits other countries around the world. In Miskin's words, a return to normal only appears in cases where the fundamental value of assets is predominant. I believe that the current difference in intrinsic value between American companies and companies in Europe and other countries is greater than at any other time. Thank you.